Hi curious friends, today we will talk about best investment plans in India for year 2022. First one is Public Provident Fund. This government-backed fixed income scheme can be generally risk-free investment as its returns are guaranteed by the government. It is normally available at almost all Indian banks and post offices. There is no restriction on the age limit to open an account. A minor's account is handled by their guardian till the age of 18. Minimum investment amount is 500 rupees per year. Partial withdrawals are only allowed after 5 years of the account opening. Best part is that investment in PPF is tax-free. There is low risk in this investment. Second option is National Savings Certificate. National Savings Certificate is considered risk-free investment. It is a government-backed fixed income investment scheme. The certificate can be easily bought at Indian public banks, some private banks and all post offices. A minimum investment amount of 1000 rupees is mandatory. You can invest any amount in the multiple of 112 installments in one financial year or the desired deposit at once. Interest compounds annually at the rate announced by the Ministry of Finance every quarter. National Savings Certificate has a lock-in period of 5 years. Currently, investment up to 1.5 lakh per annum is exempt from your taxable income under Section 80C of the Income Tax Act. Third option is Post Office Monthly Income Scheme. The scheme provides account holders to receive benefits on the interest earned on the lump sum deposit that are payable every month. The government-backed scheme offers 6.6% interest rates on both individual and joint accounts. A minimum investment of 1000 rupees is required to open an account and a maximum balance of up to 4.50 lakh and 9 lakh are permitted for single and joint accounts. The scheme offers an interest rate of 6.6% per annum payable monthly. Interest earned on the deposit is taxable. Fourth option is Sovereign Gold Bonds. Sovereign gold bonds are government securities issued by the Reserve Bank of India and denominated in grams of gold. They are issued in multiples of grams of gold with a minimum investment of 1 gram. Sovereign gold bonds are open for auction on dates announced by the central government. These bonds are issued by the RBI multiple times a year. You must have a PAN card to buy in sovereign gold bonds. Return on investment is 2.5%, which is paid twice a year. Interest payments will be taxed based on your tax slab. Fifth option is Equity Mutual Funds. An equity mutual fund is an investment vehicle that pools investors' money and invests it in stocks to generate returns. You can normally invest via agencies and stock brokerage companies online or offline. Most mutual funds expect a minimum investment of 1000 rupees and there is no cap on the maximum amount that can be invested. There are mainly 8 types of equity mutual funds for investors to choose from. Investors are free to redeem their investments in open-ended equity mutual fund schemes. Equity mutual funds are known to deliver the highest returns among other kinds of mutual fund investments, but it depends on the market fluctuations and the overall economic scenario. In case of a short-term capital gain, tax is applied at 15% plus 4% cess. Sixth option is Gold Exchange Traded Funds. Gold exchange traded funds are equivalent to buying gold in the physical form without the hassle of holding physical gold. They require investors to open a demat account and hold gold units in a dematerialized form similar to how investors hold mutual fund units. You can buy units of gold by opening a demat account, exactly in the same manner that one invests in shares from the stock brokerage companies and agencies registered with SEBI. There are gold funds in the market where you can start at as low as 500 Indian rupees. You can exit a gold ETF when you want, there is no lock-in period. Their return depends on the gold ETF's performance in the market. If you sell your gold ETF before 36 months of acquiring it, then you will be taxed as per your slab. Seventh option is REITs. REITs enable an investor to invest in a portfolio of income-generating real estate assets by purchasing units of the REIT similar to units of a mutual fund. Any income generated by the underlying real estate assets is then distributed by the REIT to its unit holders. REITs are listed and traded on the stock market, just like equity shares. Therefore, a demat account is mandatory for investing in REITs in India. At present, there are 3 REITs that allow investors to invest in India. The minimum investment criteria of 10,000 to 15,000 rupees is applicable for investment through initial public offerings and follow-on offers of REITs that are listed on the stock exchanges. REITs are mandated to deliver 90% of their portfolio's net rental revenue as dividends or interest to their shareholders. Investing your money in financial products that could help you generate a return carry its own risks. Before making an investment in any of mentioned option, it is prudent to learn about the prospective risks related to the product that you are investing in thoroughly. Thanks for watching.